Hello, my dear students. Today we are going to explain one numerical problem related to retirement of a partner, and this problem is cover of like opening revaluation account, partner's capital account, revised balance sheet, as well as payment to the retiring partner. Now directly will come our numerical problem. This is the numerical problem. There are three partners. Here you can see there are three partners. Kanika, Disha, and Kabir. Their profit sharing ratio 2:1:1, and their balance sheet, that is financial position as on 31st March 2016, all are non-term bank data stock fixed asset. This is the profit and loss account on the asset side. It is undistributed loss. Ultimately, profit and loss when debit balance, that time it is shown on the balance sheet asset side, rather than generally it shows on the liability side when it is credit balance. That time it was undistributed profit, but here it is undistributed loss. As per the rule, that loss we have to distribute to the old partner by passing an entry, that is all partners capital account debit to profit and loss account. So this side, liability side, all term is non-term, creditor, employee provident fund, and three partners capital balance, including the retiring partners capital also. That is retiring partner. Who is retiring partner? We'll see here. There is a retiring partner here. Kanika is a retiring partner, and she want to retire as on 1st April 2016 under the following terms and condition. First term, that is goodwill is to be valued at 2-year purchase of the average profit of the 3 completed year preceding the date of retirement. Here profit for the year 2013 and 14 1 lakh, profit for the year 2014 and 15 1 lakh 30,000, and profit for the year 2015 and 16 here in adjustment not provided. Sometimes learner can face difficulty that where is 1 year profit. That profit is not provided, so it does mean the question is wrong. So that type of thinking may can arise in the learner mind during examination hall, but here it is not correct. Question is correct. Profit here it is not provided, but it is provided on the balance sheet. Once if you want, we can see it here. That is the profit and loss account balance. This is the current year loss actually. Here it is provided on the balance sheet, not in the adjustment. So this has to consider as a third year or current year. So therefore, it is the first year, it is the second year, and balance sheet on third year will consider this 3 year. Now first we will find out the average profit, like 1 lakh plus 1 lakh 30,000 minus 20,000 divided by 3. That will give the average, and after getting the average, we will multiply by 2. That will come the total firm's goodwill, and that of we will find out the retiring partner's share of goodwill. Retiring partners here it is provided 2:1, so 2 by 4, that is half will be the retiring partners here. So this is the first one adjustment. Now second one adjustment, fixed asset are to be increased to rupees 3 lakhs. The fixed asset value here it is provided. Fixed asset value here 2,40,000, which is increased to 3 lakhs. So therefore 60,000 increase as per rule. Fixed asset account debit to revaluation account, that entry will pass here. Now another changes also take places regarding the stock. Here stock value it is provided 1 lakh. Here regarding the stock, here it is mentioned this stock was to be valued at 120%, means ultimately 20% we have to increase. So 1 lakh into 20%, that is 1/5, that is 20,000 coming here. Another way, or you can do here 1 lakh into 120%. After that you can compare how much value will increase, that you have to take. That time stock account debit to revaluation. So this is the common adjustment. Now next adjustment, that is the new in this chapter, that is retiring partner. That is Kanika is a retiring partner, and total benefit will be transferred to her loan account. So how we calculate the total benefit? Now for that we have to open the Kanika's capital account. After opening the Kanika's capital account, we will give her all benefit like opening capital balance, if any unlisted profit is there, if any revaluation profit is there, if any goodwill is there, goodwill benefit, all you have to transfer in her account, and then we have to find out her total amount or total benefit by making the difference between credit and debit. Let's see the solution here. Which solution are there? This is the revaluation ledger. One is stock value increases 20,000. It is 1 lakh into 120 by 100. That is coming 1,20,000. 1,20,000 minus 1 lakh. That is 20,000 that way, or another way we can directly 1 lakh into 20%. That way also you can find out the increased value. That is coming this side. Now fixed asset 60,000 increases. So only at the time of retirement, only these two asset value changes, and that is like increased value. It does mean profit on revaluation. That profit generally you have to transfer to all partners, including retiring partner. Retiring partner here, Kanika is a retiring partner. So we have to transfer Kanika also. In the old ratio 2:1:1. So therefore, Kanika's share of profit 40,000. This is share of profit, that is revaluation share of profit 20,000, and Kabir 20,000. So this is the revaluation profit which is being transferred to the all partners, including retiring partner. Now next step, that is opening partners capital account. Here we know that opening balance by balance video you have to consider all the partners here, like Kanika's capital 2 lakh, this is 1 lakh, and Kabir 80,000. This is related to the goodwill. This is related to the goodwill. The journal entry is there. That is remaining partners to retiring partners, or gaining partners to like sacrificing partners. Like the partner who retired, generally he or she sacrifice his or her share to the remaining partner. So Kanika is a retiring partner. So Kanika's share, it is sacrifices to like Diksha and Kabir, and Diksha again. So here the journal entry here, remaining partner, that is Diksha and Kabir partners capital account debit to retiringness to Kanika, and the value of goodwill, that is 35,000. We can see the value of goodwill from the working here. This is the working goodwill, average profit into number of year purchase. There is a formula for calculation of goodwill under average profit method. We know from the chapter 2, that is change in profit sharing ratio. Average profit, that is first year, second year, as well as third year. First year profit positive, and this one is coming at a loss negative. So it is coming after adjustment 2,10,000 divided 3, that is 70,000. That is average profit. Now the value of goodwill, average profit into 2. So 70 into 2, 1,40,000. So there is total funds, goodwill 1,40,000. Thereupon we have to find out the retiring partner's share. Retiring partner's share is 2/4. So 1,40,000 into 2/4, that is 70,000. This 70,000 will be borne by the like remaining partner or gaining partner, that is these two partner, Disha and Kabir, in their gaining ratio. Nothing mentioned about the gaining ratio, so therefore here it is 2:1:1. Will cancel the will cancel the Kanika's share, so that remaining left here 1:1. Equally, ultimately the remaining partner gaining ratio become equal, it is 1:1. Therefore 35,000 to Disha and 35,000 to Kabir. So like that way it is distributed. So that is why this entry is there, that Disha's capital account, Kabir capital account debit to Kanika's capital 35. Then reverse entry, contra posting. Now we know from the chapter 2, change in profit sharing ratio. So these two amount by Disha, Kanika's column, by Kabir, Kanika's column 35. Now after that, revaluation profit is transferred here, and one undistributed losses is there, that will be also transferred to profit and loss account. That is all the partner, because retiring partner have to bear this loss also. Retiring partner getting these are the benefit, but one loss is there, so that loss have to bear. Now after that we'll compare here. Kanika's credit side is coming 3,10,000 minus 10, so 3 lakh have to pay. But partner, as per agreement, the retiring partner amount will have to transfer to respective loan. So therefore Kanika's capital account debit to Kanika's loan account. This is loan. The partnership firm has to pay this amount to the retiring partner. Like as per agreement, if like payment is due, so that time you have to calculate 6% rate of interest as per Partnership Act 1932 and the section 37. Now regarding the remaining partner, they will continue the business, so therefore no need to make any payment. Their balance will have to find out. So this has balance, current balance 80,000, and Kabir current balance 60,000. That will goes to the new balance sheet. Now we'll see the new balance sheet here. New balance sheet as it is, no changes here. Employees provident fund as it is, state creditor as it is. Now this time Kanika is a third partner. She is not at all a partner of this firm. So therefore it is shown as a lender account, like Kanika loan provided to the firm 3 lakh. That way you have to assume. Now partnership firm, when you will repeat the loan, that time Kanika's loan will not appear in that balance sheet. But this capital, that is remaining partner's capital as it is, will continue till to the close of the business. But here and they are running their business, so therefore their capital, this is capital, current capital 80, Kabir capital 60, and 1,40,000 came. On this side, all are remain same. This time bank balance remain unchanged because any cash outflow inflow is not there. Data unchanged, stock here changes as per revaluation figure will take here, fixed asset also revaluation figure we are taking here. So this way numerical problem easy, very simple, everyone can do. Only the sequence you have to maintain, which way we did in case of change in profit sharing ratio, which we did in admission. We devoted lot of time for preparation of admission. That is a lengthy chapter and so many problems we solve, and we have the sufficient idea. But only the changing portion here, retiring partner payment purposes, that part you have to remember. Just it is opposite. When it is admission, that time new partner bring the cash, that time bank balance is changes, it is plus plus plus. And when it is retirement, bank balance will decrease if the payment made by cash. If suppose payment made by cash, so here only 60,000 cash is there, but the payment it is 3 lakhs. So how can you make payment here? Maximum 60,000 you can make, that time bank balance will be 0. Remaining 2,40,000 you can show as a loan. But here as per agreement we are showing here, as per instruction we are showing the total amount transferred to the loan. So there is the difference between admission and retirement. In case of admission, bank balance will increase, and in retirement, bank balance will decreases. And other thing here, capital, when it is admission, here one more partner's capital will come, and here one partner's capital, it is decrease, capital balance, retiring partner balance will decrease. So this reverse point you have to remember, and rather than all are same and quite easy. Like those who learn properly admission, it will not make any difficult in case of doing this chapter, as well as death also we can feel easy. Now will come theory based accounting. 1 to 3 question, theory based accounting. This is a very simple question. Goodwill is recorded in the books only when it is purchased. True or false? Goodwill is recorded in the books only when it is purchased. There are two types of goodwill. One is like self-generated goodwill, another purchase goodwill. When it is self-generated goodwill, as per accounting standard 26, no self-generated goodwill will appear in the balance sheet. But when it is purchased goodwill, that time you have to show in the balance sheet. So as per rule, accounting standard 26, this statement is true or correct. Now we'll come to the next question. Yes, as per the section 37 of the Indian Partnership Act 1932, in the absence of partnership deed, the retiring partner is entitled to interest at the rate of -% till the time amount due to him is not paid. So ultimately, when retiring partner payment is not being paid and transferred to the loan, so that time at what rate of interest we have to charge till to the payment not paid. So here already like numerical question, that time I already told that in case of Kanika's amount not paid, then this rate will vary. I think say it will be 6% interest. Now the last question. Gaining ratio is calculated by the difference between old ratio new ratio, option A, or old plus acquire, option B, option C, NR minus over, and option D, NR plus over. This is not possible, and this is also not possible because this one we know from admission that is called sacrificing. So these two you have to think which one is correct. Old ratio plus acquire, old ratio plus acquire, that is coming new. So this is also not. So this is correct here. NR minus over. And another way, if this is the sacrificing, so that will be the gaining ratio. So this way you can find out the which is correct. So I think so this will also quite easy and learner are able to solve this type of problem as well as numerical problem. Okay, thank you. That's all.